Good evening. This is part one of the video. In this, I would be covering specifically about the foreign institutional investors in India. And this is the beginning of our series whereby we would be talking about foreign institutional investors. But this is a three-part series. So this is part one. So followed by followed by part two and three. Now, first of all, we need to understand that why India need foreign institutional investors. Indian capital market is not as big as we have American capital markets. But that's a separate thing that the corruption in the Indian media and the Indian capital market is as big as we have more bigger than we have in United States. The right fact is a bank, Goldman Sachs, who sits at the asset base of near about $1 trillion, which is near about 33% of the Indian GDP. So as we speak, Indian GDP is about 3.3 trillion. I don't know how accurate is this figure, but it is said that Indian GDP is near about 3.3 trillion. Goldman Sachs is sitting at an asset base of near about 1 trillion. In fact, little bit more than 1 trillion, which means near about 33% of the Indian GDP. If we look at the share price of Goldman Sachs, then this is around $390. Well, if I look at JP Morgan Chase, who also have a very huge asset base, their share price is near about 160 to 170 US dollars. I will not take other banks into consideration because it will consume little time. But if I look at the Indian banks, and none of the Indian banks is near to the asset base of Goldman Sachs and JP Morgan. None of the Indian banks, which includes HDFC, ICICI, Kotak Mahindra Bank, ICICI Bank, Bandhan Bank, RBL Bank, and many other small finance banks. But if you look at the share price of these banks, you will never realize that there is a hell lot of difference between the top banks like Goldman Sachs, JP Morgan, compared with the Indian bank. Not only in terms of asset disclosures, but also in terms of the reporting of the balance sheet. If you look at the 10K, actually in US the annual report is known as 10K. If you look at 10K of Goldman Sachs, which is widely available on their website, since it is a public document, you will feel like they disclosed almost everything about their company, their bank, about their positions, about their derivative, about their hedge accounting, about the Basel 3, about the Pillar 3, and everything. Similar is the case with JP Morgan, Morgan Stanley, almost intact. But if you look at the annual report of Indian banks, you feel like it is a trash. But God is very kind. Indian media is highly corrupt. You will never realize that anyone from a knowledge base will come on the media and speak against the banks. It would never happen. Rather, Indian banks, specifically talking State Bank of India, phased out billions of dollars worth of NPM. According to the public information, Indian banks phased out near about 11 lakh crores, which is a huge amount, 11 lakh crores in the last 7 to 8 years. So non-performing asset worth 11 lakh crores being phased out by Indian banks in the last 7 to 8 years. Statistically speaking, 11 lakh crore is near about 150 billion US dollars. 150 billion US dollars, which is approximately 5% of the Indian GDP. Which means in the last 7 to 8 years, 5% of the Indian GDP is phased out in the form of non performing assets. But did anyone dare to speak on this? Did anyone dare to report that who all the corporates who got this funding? No, it would never happen. Henceforth, Goldman Sachs, JP Morgan, Morgan Stanley, and other big American banks should learn from India that even though their counterparts are extremely small, but their share price are much bigger than them. But you know that in Hindi we call natak. Natak can only be done till an extent. India was FII dependent, India is FII dependent, and India would continue to be FII dependent. We have seen historically that when FII sells in India, market drops. And when FII buys in India, market up. Because the capacity of the domestic institutional investors in India are limited. Of course, I shot many videos covering domestic institutional investor, and I would be making separate videos covering domestic institutional investors in the last 1 to 2 months. But in this video, where we are starting a series on foreign institutional investor, we would be specifically talking about foreign institutional investor. To cut the long discussion short, whatever natak we are looking at our capital market, this natak is only on the media channel. Because the reality is India is an institutional dependent economy. I repeat, institutional dependent economy. Now, by institutional dependent economy, I mean that, whether this is foreign institutional investor who invest extensively in the Indian market, or whether this is private equity, venture capitalist firms who take strategic positions in loss-making Indian startups, run for many years, and then with the help of the regulators, they get IPO approval. And as we speak, the latest is the Delhi Valley. Delhi Valley, a loss-making company, got approval of IPO, and to the tune of 1 billion US dollars. You heard me right, 1 billion US dollar. So India is a very different setup. If you do anything wrong, then you have regulators. But the loss-making companies get billion-dollar approval knowing the fact that the company is in losses since inception. They have a negative retained earnings, which is an accounting issue. Going concern is an issue, irrespective they being allowed to raise the money from the retail investors. But this is legal. This is completely legal. Near about 33%, 2500 crores, is the OFS component of Delhi Valley. OFS stands out, offer for sale, now, which means that existing investors quitting and retail investors came into the picture. So now in the first part, I clarified that India is an institutional dependent economy. Now, Being an institutional dependent economy, you need to understand that institutional have the firepower. Now by firepower, I means the money. Since they have the firepower, media and all other institutions are in their pocket. Simple. Have you ever seen a single institutional investor being fined? Never. Have you ever seen any loss making company in India is not approved for IPO? Never. In the part B, we would be talking about FII strategies as we speak. Thank you.